Hey friends, welcome back to She Talks Money. I'm your host Jennifer Butcher, and today I'm actually putting on my lender hat because we're going to talk about mortgage pre-approval. Specifically, the stuff nobody actually explains properly, in my opinion. Everybody knows the basic version. Check your credit, get pre-approved, go look at houses. That's cute, it's adorable, and it's not even close to the whole story. What actually determines whether you get approved and stay approved all the way to closing comes down to a handful of things that underwriters are quietly evaluating the entire time. Your debt to income ratio, how a job change mid-process can blow up your file, what actually counts as seasoned money in your bank account, and why that new couch you bought this week right before closing might be the reason your loan completely falls apart. So today, I'm walking you through exactly what's happening behind the curtain, the stuff I explain to clients all the time that I wish everyone knew before they even started house hunting. So let's get into it. First up, let's talk about debt to income ratio, or DTI. If there's one number that quietly controls your entire approval, it's this one. And here's what it actually is. It is your total monthly debt payments, including the new house, car loans, student loans, credit cards, the new mortgage payment, divided by your gross monthly income. Lenders use this to answer one question: can you actually afford this on top of everything else you're already paying? Most conventional loans want your total DTI under like 43 to 45%, though there are some programs that allow more depending on the rest of your file. But here's the part people miss. It's not just your current debt. It's every debt showing up on your credit report, even if you're not actively using it. That store credit card with a $30 minimum payment you forgot about, it counts. That car you're about to sell but haven't yet, it still counts until it's actually paid off. Or you transferred something you transferred out of your name. So before you even start house hunting, pull your credit report or have your lender and add up your minimum payments. If your DTI is sitting high, the fastest lever to pull usually isn't paying off the smallest balance. It's paying off whichever debt gets rid of an entire monthly payment. So killing $150 a month payment often moves the needle more than shaving a big balance down without eliminating the payment itself. Second thing we're looking at is the job changes. This one blindsides more buyers than almost probably anything else, because lenders want to see income stability, typically a 2-year history in the same field, even if you've switched employers within that field. Switching companies doing the same type of work, that's usually fine. Switching from salary to commission or being an employee to being self-employed, that's a different conversation entirely, because now your income has to be proven differently, often requiring tax returns showing an established track record, not just a new offer letter. And here's the part that really gets people. Even a great new job with a raise can cause problems if the timing is wrong. So if you switch jobs in the middle of your mortgage process, your file has to often be re-underwritten with new pay stubs, a new verification of employment, sometimes a new offer letter breakdown. Best case, it might delay closing. Worst case, it's a new role that has a probationary period or a different pay structure, and it can put your approval at risk entirely. My blunt advice is, if you're seriously planning to buy a home in the next 6 months, don't make a job change that you don't have to make. And if an opportunity is genuinely too good to pass up, then just tell your lender about it immediately. Don't let it show up as a surprise mid-process, or definitely don't try to hide it. We're going to find out, so make sure we have a discussion about it. All right, next up is seasoned funds. What that actually means, okay? Seasoned funds is, you're going to hear this term thrown around and almost nobody really explains it clearly, in my opinion. Seasoning basically means your lender wants to see that the money in your bank account has been sitting there for a while, typically 60 days, so they can confirm it's genuinely yours, not a loan in disguise or not a gift that hasn't been properly documented, not a mystery deposit that needs an explanation. So here's where it gets people in trouble. Any large undocumented deposit shows up during underwriting, it needs a paper trail. If you sold something on Marketplace for a few $1,000s, you need documentation. If you got a cash gift from a family member, we need a gift letter and sometimes proof of where that money came from too. Moved money between your own accounts right before applying. Even that can trigger like a request for some statements showing where it originated. So the simplest fix is get your down payment and your closing costs sitting in one account at least 2 months before you apply, and avoid large unexplained deposits during that window. If a big deposit is unavoidable, keep the documentation ready before your lender even asks for it. All right, next, the big purchase that can tank a closing. The one that breaks my heart every single time it happens is the big purchase mid-process. Here's the thing people don't realize. Your approval isn't a one-time snapshot, okay? Lenders typically pull credit, again, not an actual hard credit pull, but we monitor credit sometimes to the day before closing or the day of closing. So if you opened a card for new furniture, a new car loan, a new credit card because you got a sign-up bonus, all of that can change your DTI, your credit profile, enough to affect your approval. So sometimes at the worst possible moment too, like just days before closing, when you're supposed to get your keys. So my rule for clients is from the moment you're under contract until you have keys in your hand, treat your credit and your bank accounts like they're frozen in time. Don't open new credit, don't finance furniture, don't make untraceable large purchases in cash you were supposed to use for closing. Save the new house shopping spree for after closing day, not before. So, watch your debt to income ratio before you even start house hunting. Think twice before changing your jobs mid-process. Let your money season for at least 2 months and freeze your spending habits between contract and closing. This stuff isn't complicated. Once you know it, it's just rarely explained clearly before people need it. And now you know. And if this helped, send it to someone you know who's about to start house hunting, and hit follow so you don't miss next week's episode. Until then, this has been She Talks Money. Go get pre-approved, your pre-approval locked in, and have an awesome week.